The Slow Erosion of the Dollar's Throne, a narrative on de-dollarization and the rise of new currencies. The US dollar has long been the linchpin of the global financial system, a towering symbol of economic power that has shaped international trade, investment, and monetary policy since the end of World War II. Its dominance was cemented through historical agreements, geopolitical might, and the sheer size of the US economy. Yet, as the world enters the third decade of the 21st century, cracks are appearing in this once unassailable foundation. A growing chorus of nations, from emerging powers to long-standing allies, is questioning the dollar's supremacy, driven by geopolitical tensions, economic shifts, and technological advancements. This narrative explores the gradual movement away from the US dollar, the reasons behind it, and the contenders vying to reshape the global financial order. While the dollar's fall is not imminent, the world is undeniably inching toward a multipolar currency system, with profound implications for economies and individuals alike. The dollar's reign and the seeds of change. In the aftermath of World War II, the world was in disarray. Europe lay in ruins, and the United States emerged as the unchallenged economic superpower. The Bretton Woods Agreement of 1944 formalized the dollar's role as the world's reserve currency, tying it to gold and making it the anchor for global trade and finance. Countries held dollars in their reserves, used them to settle international transactions, and priced commodities like oil in the greenback. This system, often called the petrodollar, was solidified in the 1970s when the U.S. struck a deal with Saudi Arabia to price oil exclusively in dollars, ensuring a constant global demand for the currency. The dollar became more than money. It was a symbol of American hegemony, a tool of influence, and a privilege that allowed the U.S. to borrow at low costs and wield financial sanctions with unmatched power. For decades, this system held firm. The dollar accounted for nearly 80% of global foreign exchange transactions, over 60% of central bank reserves, and the vast majority of international debt issuance. It was the currency of choice for trade, from Brazilian soybeans to Japanese electronics, because it was stable, liquid, and universally accepted. The U.S. economy, underpinned by deep capital markets and a robust legal system, inspired confidence. As one economist put it, if you wanted a safe asset, you went to the US dollar. It was as good as gold, until it wasn't. The first whispers of change came in the early 2000s. The US's share of global GDP began to shrink as emerging economies, particularly China, grew at breakneck speed. By 2025, China's economy was the second largest in the world, and its influence in global trade was undeniable. Meanwhile, the U.S. faced internal challenges, ballooning national debt surpassing $33 trillion, inflationary pressures, and political polarization that raised questions about its fiscal stability. Abroad, geopolitical shifts were brewing. The 2008 financial crisis exposed vulnerabilities in the US-led financial system, prompting some nations to seek alternatives. The 2022 Russian invasion of Ukraine and subsequent Western sanctions, which froze Russia's dollar-based reserves, sent shockwaves through the global south. Countries like China, India, and Brazil began to ask, if the US could weaponize the dollar, what was to stop it from targeting them next? These events planted the seeds of de-dollarization, a term that encapsulates the gradual reduction in the use of the US dollar for trade, reserves, and financial transactions. It's not about replacing the dollar overnight but about diversifying away from it, creating a world where no single currency holds absolute sway. The movement is driven by a mix of pragmatism and defiance, as nations seek economic sovereignty, hedge against U.S. influence, and embrace new technologies that make alternatives viable. The catalysts of de-dollarization. The push to move away from the dollar is not a single event but a confluence of economic, geopolitical, and technological forces. Each catalyst tells a story of a world rethinking its reliance on a currency tied to one nation's policies. Geopolitical tensions and sanctions. The U.S. has long used the dollar as a geopolitical weapon. By controlling access to dollar-based financial systems like SWIFT, Society for Worldwide Interbank Financial Telecommunication, the US can impose sanctions that cripple economies. The 2022 sanctions on Russia, which froze nearly half of its $630 billion in foreign reserves, were a wake-up call for many nations. Russia, a major oil and gas exporter, was forced to pivot. It reduced its dollar holdings, increased gold reserves, and began trading in Chinese yuan and Indian rupees. China, watching closely, saw a future where its own reserves could be at risk, especially given tensions over Taiwan. "The dollar is our currency, but your problem," quipped Treasury Secretary John Connally in 1971 after the U.S. ended the dollar's gold convertibility. That sentiment now fuels distrust among nations wary of U.S. financial dominance. Countries like India, Brazil, and even U.S. allies in the Gulf are exploring non-dollar trade channels. The BRICS bloc, Brazil, Russia, India, China, South Africa, and new members like Iran and the UAE, has become a vocal advocate for de-dollarization. At the 2024 BRICS Summit, leaders discussed alternatives to SWIFT, including blockchain-based payment systems and local currency trade. These efforts are not just about economics, they're about asserting sovereignty in a world where financial sanctions can feel like economic warfare. Economic shifts and the rise of China. The U.S.'s declining share of global output is another driver. In 1990, the U.S. accounted for about 25% of global GDP. By 2025, that share had fallen to around 15%, while China's rose to over 18%. China's growing trade dominance, 61 countries now counted as their largest trading partner compared to 30 for the U.S., has given it leverage to promote the yuan. China has signed currency swap agreements with nations like Brazil and Argentina, allowing them to trade in yuan without needing dollars. In 2023, Brazil and China settled their first trade deal in yuan, bypassing the dollar entirely. Yet, the yuan's rise is not without hurdles. China's capital controls and lack of a fully convertible currency limit its appeal as a global reserve currency. Only 2.3% of global reserves are held in yuan, compared to 58% in dollars. Still, China's cross-border interbank payment system, CIPS, and its digital yuan pilot are laying the groundwork for a yuan-based financial ecosystem. China isn't trying to replace the dollar overnight, said a Beijing-based economist. It's building a parallel system, one trade at a time. Technological disruption. Technology is rewriting the rules of global finance. Blockchain and digital currencies are reducing the need for traditional intermediaries like SWIFT, which is heavily dollar-centric. China's mBridge project, a blockchain-based platform for cross-border payments, allows countries to settle transactions in local currencies or digital assets, bypassing the dollar. Russia and Iran, both under U.S. sanctions, are early adopters. Meanwhile, central bank digital currencies, CBDCs, are gaining traction. By 2025, over 90 countries were exploring or piloting CBDCs, which could enable faster, cheaper cross-border payments without relying on dollar-based systems. Cryptocurrencies like Bitcoin, while volatile, are also part of the conversation. Some nations, particularly those facing sanctions, see crypto as a way to circumvent dollar dominance. However, their lack of stability and scalability makes them unlikely to replace fiat currencies soon. Instead, they highlight a broader trend: the world is experimenting with alternatives, and technology is making it easier. Economic vulnerabilities in the U.S. The U.S.'s own economic challenges are fueling skepticism about the dollar. With a national debt exceeding 120% of GDP and persistent trade deficits, some investors question the dollar's long-term stability. The U.S. dollar index, DXY, fell 8.8% year-to-date as of June 2025, reflecting mixed signals from U.S. policies. President Trump's threats of 100% tariffs on countries moving away from the dollar have created uncertainty, while his criticism of the dollar's strength as a disaster for manufacturers adds to the confusion. Inflationary pressures and rising interest rates to combat them have made servicing U.S. debt costlier, raising fears of a potential default. These vulnerabilities don't spell the dollar's imminent collapse, but they erode the confidence that underpins its dominance. The dollar's strength is built on trust, said an IMF economist. If that trust wanes, the slide could accelerate. The contenders for the throne. If the dollar's grip is loosening, what currencies or systems might take its place? The answer is not a single currency but a multipolar system where several contenders share the stage. The Chinese yuan, a rising star with limits. The Chinese yuan, or renminbi, is the most prominent challenger. As the currency of the world's second-largest economy, it has a strong case. China's trade dominance and its push for yuan internationalization, through swap lines, CIPS, and digital yuan trials, have boosted its global use. In 2024, the yuan accounted for 7% of global foreign exchange transactions, up from 2% a decade earlier. Russia now uses the yuan for over 50% of its trade, and countries like Brazil and India are increasing yuan-based transactions. However, the yuan faces significant barriers. China's capital controls restrict its convertibility, and its financial markets lack the depth and liquidity of the US's. Political risks also loom. The yuan is issued by an authoritarian regime, which deters some central banks. Every reserve currency in history has been tied to a democracy with checks and balances, noted economist Barry Eichengreen. The yuan's share of global reserves, at 2.3%, reflects these limitations. Still, China's long-term strategy is clear: it's building a yuan-centric ecosystem that could gain traction as its economy grows. The euro, a distant second. The euro, used by 20 European nations, is the second most held reserve currency, with a 20% share of global reserves. Its stability, backed by the European Central Bank, and the EU's economic weight make it a contender. The euro is widely used in trade, especially in Europe and Africa, and its share of global foreign exchange transactions is around 30%. Yet, the euro's potential is hampered by the EU's fragmented fiscal policies and economic disparities among member states. The 2008 financial crisis and subsequent eurozone debt crises exposed these weaknesses, denting confidence. The euro also lacks the geopolitical clout of the dollar, as the EU is not a unified political entity. The euro is a strong regional currency, but it's not ready to challenge the dollar globally, said a European central banker. Non-traditional currencies, the dark horses. Surprisingly, some of the biggest gains in reserve holdings are coming from non-traditional currencies like the Australian dollar, Canadian dollar, and South Korean won. These currencies, issued by stable, open economies, offer higher returns and lower volatility than the yuan or euro. According to the IMF, these currencies account for 3/4 of the shift away from dollars in recent years. Their rise reflects a trend toward diversification rather than a single currency replacing the dollar. Gold is another alternative gaining traction. Central banks, particularly in Russia and China, have increased gold holdings as a hedge against dollar volatility and sanctions. Gold's share of global reserves, while still low at around 10%, is at a historical high. Gold is a safe haven in a fragmented world, said a Russian central banker. However, gold's lack of liquidity and inability to facilitate transactions limits its role. The BRICS currency dream. The BRICS bloc has floated the idea of a common currency, potentially backed by a basket of member currencies or gold. At the 2024 BRICS summit, discussions focused on cross-border payment systems and blockchain technology to reduce dollar reliance. Brazil, holding the 2025 presidency, plans to prioritize these initiatives. However, a BRICS currency faces daunting challenges: member economies are too diverse, and political disagreements, such as India's refusal to use the yuan for oil payments, complicate coordination. A BRICS currency is more symbolic than practical for now, said an Indian economist. Cryptocurrencies and CBDCs. Cryptocurrencies like Bitcoin are often cited as potential disruptors, but their volatility and regulatory challenges make them unlikely candidates for reserve status. CBDCs, however, are a different story. China's digital yuan, Russia's digital ruble, and other CBDCs could streamline cross-border payments, reducing the need for dollar intermediaries. The mBridge project, which includes BRICS nations, is a step toward this future. While CBDCs won't replace the dollar soon, they could chip away at its dominance by enabling a more fragmented financial system. The implications of a multipolar currency world. A shift away from the dollar would reshape the global economy, with both risks and opportunities. For the U.S., the loss of reserve currency status could mean higher borrowing costs, as demand for treasuries wanes. The exorbitant privilege of issuing the world's reserve currency, low interest rates and the ability to run large deficits, would erode. American consumers might face higher prices for imported goods, and U.S. exporters could struggle as a stronger dollar makes their products less competitive. For the rest of the world, de-dollarization could reduce exposure to U.S. monetary policy and sanctions. Emerging markets, often hit hard by dollar fluctuations, could benefit from trading in local currencies, which balances risks and lowers transaction costs. However, a multipolar system introduces complexity. Exchange rate volatility could rise as markets adjust to multiple reserve currencies. International debt, much of it dollar-denominated, could become harder to manage if dollar values fluctuate wildly. For individuals, the impact depends on location and economic ties. In the U.S., a weaker dollar could raise the cost of imports, from electronics to fuel, squeezing household budgets. In contrast, countries with diversified reserves or local currency trade could see more stable prices. For investors, a multipolar system offers opportunities to diversify into non-dollar assets, such as gold, yuan, or Australian dollar bonds, but it also increases risks of currency volatility. The road ahead. The dollar's dominance is not ending tomorrow. It remains the world's primary reserve currency, used in 88% of foreign exchange transactions and 58% of reserves. Its liquidity, backed by deep U.S. capital markets and a stable legal system, is unmatched. No single currency, not the yuan, euro, or a BRICS basket, is poised to replace it in the near term. As one analyst put it, the dollar is still king, but the crown is getting heavy. Yet, the trend toward de-dollarization is unmistakable. Central banks are diversifying reserves, with the dollar's share falling from 71% in 1999 to 58% in 2022. Trade in local currencies is growing, driven by BRICS initiatives and technological advancements. Geopolitical tensions, from U.S.-China rivalry to sanctions on Russia, are accelerating this shift. The rise of CBDCs and blockchain-based systems could further erode the dollar's role by making non-dollar transactions easier and cheaper. The future is likely a multipolar currency system, where the dollar remains first among equals but shares influence with the yuan, euro, and smaller currencies. This transition will be gradual, taking decades rather than years, as institutional frameworks like SWIFT and deep-seated trust in the dollar are not easily replaced. But the momentum is clear. As China builds its financial infrastructure, as BRICS nations experiment with new systems, and as technology disrupts traditional finance, the world is moving toward a new equilibrium. A world in transition. Imagine a Brazilian farmer selling soybeans to a Japanese buyer in 2035. Instead of converting yen to dollars and then dollars to reais, they settle the trade in a digital BRICS currency, facilitated by blockchain. Or picture a central bank in Africa holding a mix of yuan, euros, and gold, hedging against dollar volatility. These scenarios, once far-fetched, are becoming plausible. The dollar will remain a major player, but its monopoly is fading. For individuals, this means preparing for a world where currency choices matter. Diversifying savings into gold or foreign bonds could hedge against dollar weakness. For nations, it's about building resilient financial systems that don't hinge on one currency. For the U.S., it's a call to address internal vulnerabilities, debt, deficits, and political gridlock, to maintain confidence in the dollar. The story of de-dollarization is not about the dollar's collapse but its demotion. It's a tale of a world seeking balance, driven by nations tired of one country's dominance and empowered by technology to chart a new course. The dollar's throne may not crumble, but it's sharing the stage, and the play is just beginning.